Sometimes there is so much that I want to say that I don't know where to begin. I've got a lot on my mind at the moment. There's just a ton of real estate related news that is swirling around, and I'm trying to block out all of the mainstream news outlets, or at least the headlines, because there's just this whirlwind of information and it's hard to make heads or tails. It feels like we are quickly getting to the point where it doesn't make a ton of sense and trying to get out in front and prognosticating and all other ings the spring housing market. In fact, as I mentioned in my last report, several leading experts have stopped trying to figure out the market. I mean, as an example, I drafted a newsletter 10 days ago to send out to my clients in Sphere, and it was outdated before it could even be printed. The situation in the market is fluid, and some days things are changing by the hour. The stability that buyers and sellers have been seeking feels non-existent. Nevertheless, there is quite a bit that we know, and so we can prepare as we move into the spring selling season. First, let's take a look at the national numbers and see how they relate to what's going on locally. Earlier this week, I sat through the National Housing Update with Altos Research. Founder and fellow data geek Mike Simonton said that the banking failures, had the potential to become disruptive. Based on his tone and context, I think Simonton meant that we could be in for a hard landing recession that will have a negative effect on real estate. And yet, even with the Silicon Valley Bank and Signature Bank collapses 2 weeks ago, plus the Credit Suisse bailout and First Republic woes last week, the scenery has dramatically changed for this coming spring. But I think that the effect may be the exact opposite of what we were all concerned about. So far this week, the 10-year Treasury bond has been falling, driving mortgage rates down. Fannie reported that their average for a 30-year fixed rate fell almost 0.2% to 6.42% this week. And then on Wednesday, the Fed announced that it was only raising the short-term interest rate by 0.25%. Based on Chairman Jerome Powell's comments before Congress a couple of weeks ago, many insiders felt that the Fed would continue with their aggressive rate hikes, thereby driving up interest rates across the board even further. Now that did not happen, and it looks like the Fed will only raise rates 1 or 2 more times at most this year. This is one of the clearest signals yet that the Fed believes that inflation is slowing. This is extremely good news for the housing market. And more good news, it's also looking like we are starting to turn the corner on inventory. Nationally, we saw the first increase in the number of new listings on the market week over week this year. So, as I've said before though, all real estate, like politics, is local. And we haven't seen quite the same shift just yet. There were 61 new listings in the region last week, which is 6 fewer than the week before. And I've been fairly adamant about the spring market starting later this year. And so far the data, at least on the listing end, is showing that to be the case. For the same week last year, there were 123 new listings. There is one major difference between what happened last year and this year. And that is last year, interest rates were still in the low 4%, and sellers were rushing to get their homes on the market before interest rates went too much higher. This year, we don't have the same situation, not even close. Sellers aren't super motivated to get their homes on the market because of where interest rates are. According to ATTOM research, 68% of homeowners have more than either 50% equity in their home or they paid it off completely. Everything else being equal, what is their incentive to move? So like I said last week, we are going to have low inventory for quite a while. But I am getting off topic here because the fact is that buyers are becoming extremely active again. For example, 3 new resale homes came onto the market in American Canyon 2 weeks ago. 2 of those 3 homes already went into contract within 10 days. All of them are in what is now considered to be a first-time home buyer range, which is that low to mid 500,000s. This is going to continue to be an extremely active market in the spring because, like I said, there isn't a lot of inventory. Buyers are extremely price sensitive, but it's also clear that they're extremely rate sensitive. Back in January, I reported about 5.5% being the affordability threshold, but Affordability and demand thresholds seem to be different. Data provided by the folks over at Keeping Current Matters show that when interest rates are at or below 6.5%, there is good buyer demand. Interest rates were below 6.5% for most of January and the first half of February, and we saw a flood of buyers return to the market. I believe that we'll start to see the same type of scenario now. Another thing that I found while going through the data in the last week is that the list price of homes going into contract, at least nationally, was flat week over week, and more importantly, year over year. There are a ton of anecdotal reports floating through the real estate news sites saying that it's returned to 2021. Multiple offers and bidding wars on properties. I'm not really getting the same feeling in this area, at least not with the bidding wars. Yes, homes are going above asking price, and there are certainly multiple offers, but not wildly so. I read about an agent who said that they were writing offers, releasing contingencies again. I can't impress upon you how bad an idea that is. This is going over. Happily, I'm not necessarily seeing this play out locally. Last month, homes were still selling at 96% of their original list price. Generally, this reflects inventory that came on the market in December and January, and mortgage rates were falling from their November highs, so that this is less of an issue than you might expect. While some homes will go over list price, primarily in the competitive first-time homebuyer market, the money just isn't there to go crazy above. There is even more good news on the mortgage side. This coming Monday, March 27th, the California Housing Finance Agency, or CalHFA, is releasing its California Dream for All program. This is a pretty amazing program. It is geared toward first-time home buyers, so anyone who hasn't purchased or owned a home within 3 years, and it provides a loan of up to 20% down. It is considered a shared appreciation loan, which means that the loan is repaid through an established share of depreciation in home value. It is more complicated than what I've just made it sound like, so definitely please talk to your lender. If you need a referral, I know several great lenders who would be more than happy to walk you through the process. As I sign off this week, a reminder that April is Child Abuse Prevention Month. Studies have shown that actual instances of child abuse are about 3 times more than reported. In Napa County, there were 121 confirmed victims of child abuse, which means that more than likely, the numbers were closer to 360. Every single day, a child is abused in Napa County, but we can work towards preventing that. That's why I'm supporting Cope Family Services by joining their walkathon for April. I'll be walking 30 miles in 30 days to raise money to provide necessary services and programs to struggling families, which will help in turn ease their stress and eliminate, hopefully, child abuse. I hope that you will join me by either being part of my team or donating to my team on my behalf or your behalf. Stomp out child abuse. There's a link to my team in my bio. That's all for this week on the Peterson Report. Enjoy the sun this weekend, and I'll see you on the back end.